What is a mortgage? If you've been renting your whole life, there's a good chance you aren't familiar with what a mortgage actually is. And even for many seasoned homeowners, it's also true that they don't know what their monthly payment is actually going towards. If you want to know more about this video is for you. So in simple terms, a mortgage is an agreement between you and a lender that gives the lender the right to take your property if you fail to make the payments on the money that you borrowed plus interest. Mortgage loans are used to buy a home or to borrow money against the value of a home you already own. But yes, you heard that right. It's an agreement that gives your lender the right to take your home if you don't pay it back. Did you know that 80% of all home buyers purchase their home using a mortgage? Well, I'll discuss some of the common questions regarding qualifications and what many lenders look for in another video of this series, so stay tuned. All right, so let's get down to business. The first thing you should understand about a mortgage is what's called the amortization schedule. Amortization focuses on spreading out loan payments over time. For example, many homeowners will usually use a 30-year, 20-year, or 15-year fixed rate mortgage on their purchase. In these situations, the entire loan and interest is divided into equal payments over that span of time. So by the end of that term, your entire loan balance is paid off and there's no more lien against the property. Don't worry though. Just because you have a 30-year loan or even a 20-year loan, it doesn't mean you have to actually live in the property or own it that long. That's a common myth. Did you know that 28% of all homeowners tend to move out of their home or sell it within the first 5 years? There are some really cool mortgage hacks I know about I'd love to share with you guys, and that'll be in another video to come in this series as well. And this will be how to save you tons and tons of money on interest and how to decrease your overall time that you're paying on that loan. All right, so now let's break down what your monthly payment actually consists of. We call this PITI. Each one of these is an acronym for a portion that you pay each month. So you make one monthly lump sum payment each month, but it gets divided into these 4 spots. The first one here is principal. This is also known as the balance of your loan. So just a portion of your monthly payment goes to actually paying down what you owe. So the next part of this PITI is the I. And unfortunately, the truth is, this is going to be one of your least favorite parts. This is the interest, the bank's favorite part. This is how the bank actually makes money on the loan. Of course, as we all expect, they're not giving you this money for free. They've got to make some amount of money off this. The interest rate may vary, but a portion of your monthly payment is going to be towards interest and a portion to the balance. So what you'll see if you look at your monthly statements regularly throughout the whole time you have it, in the beginning, you're going to be paying a lot more in interest than you are on your principal. But these numbers are fixed. So little by little over time, you're going to start to see the principal balance increase and the interest decrease. And the next thing we're going to discuss is the T. And the T stands for taxes. No, I do not mean taxes like when you go to the store and buy something. This is not sales tax. This is property tax. Now this is how the city and the government make their money off of your house. So the way this works is that there are actually 2 taxes on your property in the state of Michigan. You've got a city tax and a county tax. But what has been done is the lender will take the total sum between the 2 taxes, divide it by 12, as in 12 months in the year, and they will roll it into your mortgage. So that part of your monthly mortgage that you're paying is helping to cover the property taxes when they come due. That amount is going to go into what they call an escrow account, which you'll also see is included with your next portion. So finally, the other thing that goes into your escrow account is the I on our PITI list, and that is for insurance. And that's referring to homeowners insurance. Just like you might have insurance on your car, it's a requirement from the lender that you're going to have your property insured as well. Number 1, this is going to protect you in case anything bad happens to your home. And number 2, it's going to protect the lender in case something catastrophic happens. It helps to protect their asset as well. This will cover things such as a tree falling on your roof, the house burning down, and a variety of other things. Make sure you talk to your insurance provider to see what is actually covered and shop it around to see how you can get the best rates and coverage for yourself. So you think we're done here, and in many cases we are, but for a lot of buyers, especially first-time buyers who are using loans where they're putting less than 20% down, and yes, you can do that. You can go as low as 0% down in some cases. However, if you have less than 20% down, the lender's going to charge you one more fee into this thing, and it's called PMI. PMI stands for Private Mortgage Insurance. But wait, we're already paying for insurance here, right? No, I'm sorry. This is a different type of insurance. This is an insurance that actually covers the note. It covers the loan you have on the property in case you default on it and the bank can't sell it and make back the amount of money that you owe. So this PMI helps to cover any gap for the lender. And why do you have to pay it? Because the bank sees anything less than 20% equity in the house as a potentially higher risk for the loan. That number can vary based on the price of the loan, so make sure you talk to your lender and discuss what does the PMI look like on this type of loan. All right, so let's look at an example of what this actually looks like in dollars. We're gonna use this property as an example. So here we have a property in Livonia where the purchase price is $250,000. In this case, we're going to use a 3.5% down payment using an FHA loan. This down payment is $8,750, for example. This does not include closing costs, which we will discuss in another video. By the time you see this video, interest rates are going to be different. Interest rates change every single day. But in this example, we're going to use a 6.5% interest rate to get us in the ballpark of where we're looking. We're also going to be doing a 30-year amortization, which means it's a 30-year mortgage, as we discussed earlier. Here's what it looks like by the numbers. All right, so by the numbers, the first thing we want to discuss, as we did over here, is the P and the I, the principal and the interest. This is going to be a fixed payment for the life of that amortization. And in this example, it's going to be $1,524.86. The next part of this, as we talked about earlier, that's going to be going towards your escrow account, is going to be the taxes and the insurance. I've used numbers that are locally here to this specific property to help pull the tax numbers. And the insurance number that I'm using here is also an estimate. Make sure you're shopping around, you might get different rates than we're seeing here, but this is just an example. In this case, we have a yearly tax of both city and county adds up to $5,104, which equals out to $425.33 per month. Insurance, we're using an example of around $1,200 per year, which is also the equivalent of $100 per month. Last but not least, we have the PMI that I discussed earlier. Since we're using a 3.5% down payment and not a 20% down payment, we're going to be stuck with PMI. At a property at about $250,000 purchase, that PMI is going to cost you around $120 a month. So what that gets us is a total mortgage payment for this property of $2,160.19. Again, this is an example, but it's a real example. These are real numbers, but it may differ and vary based on you, your interest rate, your loan type, how much you're putting down, the property taxes, the insurance. But this is how we figure that out. And if you want some help with that, let me know. So I hope you found this information valuable so far, but I want you to stay tuned for the next video where I'm going to talk about the one thing most realtors and most lenders do not want to talk about, but everybody should be preparing for. And that's going to be a change in your property taxes. So if you live in Southeast Michigan and you like what you're seeing so far, and you're looking for some more information for yourself or someone you know, don't hesitate to reach out to me. My contact info right here. Stay tuned for more information.